In 1980, the median price of a home in the United States was $64,000. Today, it's over $420,000. Now, this price increase can be found in every country, and not just in housing. The only reason why we're talking about it today is because the price of everything has risen rapidly over the last 4 years. The cost of living has gone up by 30% in most places, and it keeps on rising. Today, we're going to explain why everything is so expensive, why it's only going to get worse, and what you can do to keep up. Stay tuned.
The price of everything on the planet, be it burgers, stocks, or Crocs, is ultimately determined by two simple factors: supply and demand. When the price of something goes up, it's either because there's a shortage of supply or an increase of demand. When it's both, then prices can go up exponentially. This is basically why the cost of living has increased so much over the last few years. The trade disruptions caused by the pandemic restrictions from 2020 to 2022 essentially caused a shortage in the supply of everything, and the extensive sanctions that we've seen since 2022 continue to restrict supply. At the same time, governments printed trillions of dollars between 2020 and 2022 to ensure that their economies didn't go into recession, despite the pandemic restrictions they had imposed. Since 2022, governments have continued to spend trillions of dollars to boost their economies ahead of elections. The practical effect of all this money printing was an increase in demand for everything, while the supply of everything remained relatively restricted. The reason why the cost of living has gone up by 30% in most places is because most governments increased the money supply by between 20 and 40%. In other words, they increased the demand for goods and services by 20 to 40%, hence why most people are experiencing 30% inflation. Of course, in many countries, inflation has been much worse, and this is primarily due to the price of energy, namely oil and gas, which is used for over 50% of global energy production. In case you hadn't noticed, energy is required for absolutely everything. It's required to power your home. It's required to make whatever device you're watching this on. It's required to produce whatever thing you're sitting, lying, or walking on. It's required to make the food you just ate or are currently eating. Heck, even the polyester used to make your clothing comes from oil. So, when energy prices rise, the price of literally everything else rises too. Now, this isn't too much of a problem for countries that produce lots of their own energy, such as the United States. For countries that import most of their energy, such as Japan, however, this is a huge problem because of the US dollar. For context, almost 90% of global trade is conducted in US dollars. This means that when Japan needs to import energy, it needs to pay for this energy using dollars. Obviously, Japan doesn't use the US dollar, it uses its own currency, the yen. That means it needs to sell the yen to buy dollars to buy energy. As we just learned, however, the price of everything on the planet is determined by supply and demand. This is also true for currencies. When energy prices rise, the demand for US dollars rises in countries that need to import most of their energy. This causes the price of the dollar to rise relative to these currencies. Although it's not the only factor, the rise in energy prices is part of the reason why the Japanese yen has lost roughly a third of its value over the last 3 years. Over that same period, the price of oil has increased by 50%. As you might have guessed, energy costs are one of the reasons why prices will keep rising. And by the way, if you're enjoying the video so far, be sure to roundhouse kick that like button to let us know and subscribe to the channel so you don't miss our next video.
Alas, poor Yorick. I knew him, Horatio. A fellow of infinite jest, of most excellent fancy, he hath borne me on his back 1,000 times. And yet, for all his vitality, he kneweth not of the Coin Bureau deals page. Where are your 60% discount on trading fees now? Your exchange sign-up bonuses of up to $60,000. Wherefore art thy discounts on hardware wallets too? If thou hadst only beheld the link in the description below, how thou wouldst have marvelled at these riches. Alas, poor Yorick. I knew him, Horatio.
Okay, back to energy. If you watched our video about all the insanity going on in Nigeria, you'll know that oil prices collapsed between 2014 and 2016, taking the country's oil-focused economy down with them. You'll also know that this collapse in oil prices was due to the sudden increase in oil supply from the United States. What you may not know is that the collapse in oil prices resulted in underinvestment in the oil industry. Lower oil prices meant oil companies were not as profitable, so investors stopped investing in these companies. To try and attract investors, oil companies started investing more in buybacks and dividends. Logically, this means that there's been a lot less money going into investing in new oil supply over the last decade. For reference, roughly $900 billion was being invested in new oil supply in 2014. Since that time, annual investment in new oil supply has been closer to $500 billion, almost 50% less. Meanwhile, the demand for energy has simultaneously increased by almost 20% over the last decade, and this increase in demand is likely to accelerate. This is due to a combination of countries with large populations increasing their standards of living and the energy needs of cutting-edge technologies like AI. Take a second to consider that fewer than 10% of India's 1.4 billion people have air conditioning. Now, it's estimated that over 50% of Indians will have air conditioning by 2037, possibly sooner. Similarly, each of NVIDIA's cutting-edge AI chips uses as much energy as an American home, and millions are being made. In case it wasn't clear already, the demand for energy is going to explode, and the supply of the largest sources of energy, oil and gas, likely won't be enough given the decade of underinvestment in new production. Now add sanctions that make it more difficult to buy oil from large producers such as Russia. It goes without saying that this is something that every government understands. It's not rocket science, just supply and demand. Unfortunately, however, many governments have opted to double down on intermittent and unreliable energy sources instead of pushing for more oil and gas investment. Besides the fact that this has made energy more expensive due to all the additional infrastructure and backup energy sources that need to be set up, it's also sent a clear signal to the oil industry and their investors. Don't even bother putting your money into new production because oil will be gone by 2030. And it's not just governments either. Asset managers such as BlackRock, which hold much of the world's wealth, have shunned the oil and gas industry because of their ESG ideology. Even mainstream media sources acknowledge that this ESG ideology is a big part of why there's been so much underinvestment. More about that in the description. I digress. Now, what's ironic is that many governments and even many asset managers and megabanks have started to pull a 180 on oil and gas. An example of the former is the EU declaring natural gas as green, while an example of the latter is JP Morgan exiting various environmental groups committed to killing oil. For governments, this pivot is because they're starting to realize that their economies require oil and gas in order to function. For asset managers and megabanks, they're starting to realize that oil and gas companies will likely be some of the most profitable investments over the next decade as energy prices continue to rise. And make no mistake, there is a high likelihood that energy prices will keep rising. Over $5 trillion of new supply investment is needed just to catch up to current demand. Given that energy is needed for everything, that means that the price of everything is likely to continue rising too. But this is just the supply side of the equation. Whereas energy is the primary input in the supply of everything, money is the primary input in the demand for everything. As I mentioned earlier, most governments didn't stop printing money after the pandemic. It's just the central banks that stopped. The politicians have continued printing a lot. Now, while most of this money printing is going towards building useful infrastructure that should bring down costs in the long term, in the short term, it's causing persistent inflation. That's simply because any money the government pumps into the economy inevitably finds its way into everything else. More importantly, this money eventually finds its way into assets like real estate. To understand why, imagine what happens when a government contracts a construction company to, say, build a bridge. This construction company will probably use that money to hire hundreds of workers. It will probably pay them quite a bit too due to the shortage of labourers, and will pay more to its executives. Statistically speaking, these labourers will probably spend most of their income on goods and services, restaurants, rent, a new truck, and so on. Chances are that most of the money that's spent will go to a large corporation, and some of that money will be given to executives and used to buy back shares. Statistically speaking, the executives of the construction company and the large corporations will spend most of their income on assets, such as stocks and real estate. Over time, this will cause the prices of those assets to rise, making other asset holders wealthier, causing ever wider wealth inequality. To put things into perspective, the top 1% hold almost 50% of all stocks, totaling almost $20 trillion. If you widen it to the top 10%, then they own almost 90% of all stocks. This might have something to do with the fact that the average pay of a CEO is 344 times higher than that of the average worker. In any case, the key takeaway is that when governments print money, most of this money eventually finds its way into assets and the pockets of the people who own them. This link is more direct than meets the eye, as government contracts are often given to friends of politicians or their biggest donors. However, this only explains the demand for assets. The demand for goods and services is driven by the average income earner. The more people there are, the higher the demand there is for things like rent. Now, the elephant in the room here is immigration, which is rising in many countries. When it comes to legal immigration, Canada is one extreme example. It added a whopping 1.4 million people in 2023. The craziest part is that most of them moved to a single region of the country. This has caused an enormous rise in the cost of living, as the supply of things like housing didn't rise as much. When it comes to illegal immigration, the US is another extreme example. Border officials encountered a staggering 3.2 million illegal immigrants in 2023. It's believed that a similar number of illegal immigrants entered Europe last year, but, well, nobody knows for sure due to its large borders and lack of surveillance. Regardless, the point is that many countries have seen a significant increase in both legal and illegal immigration over the last few years. This has resulted in an equally significant increase in the demand for everyday necessities like food, shelter, healthcare, and work, which many argue has suppressed wages. And because the supply of things like food, shelter, and healthcare hasn't risen enough to meet this demand, the prices of these things have risen for everyone. As such, the prices of assets will continue rising due to printed money, while the prices of goods and services will continue rising due to immigration. Now, make no mistake, this is not the fault of the immigrants or even the rich for that matter. That's because they are both a consequence of the even bigger force that is causing both the supply side issues related to energy and the demand side issues related to assets, goods and services. This bigger force is precisely why energy will likely continue to be in short supply and why immigration will likely continue to increase. What is this bigger force, you ask? In short, debt. Global debt is estimated to be over $300 trillion, but this just scratches the surface of the debt bubble. Derivatives debt alone is estimated to be over $1 quadrillion. That is 1,000 trillion. All you need to know about derivatives for the purpose of this video is that derivatives are backed by assets. If the value of the assets backing derivatives and other debts goes down, or in some cases up, then these derivatives lose money and the underlying assets need to be sold. Believe it or not, but government debt, aka government bonds, are a popular form of collateral, particularly US bonds. What this means is that for existing debts to be sustainable, asset prices must continue to rise and the economy must continue to grow, because if they don't, then it will create a domino of debt defaults. This means that central banks and governments must keep printing money and increasing immigration. Canada, once again, happens to be a perfect example. It has the highest level of household debt relative to income of the world's largest countries. Most of this debt is in housing, which is in a bubble. In turn, all these mortgages were issued by banks, which probably use them as collateral for other stuff. This means that Canada cannot allow the cost of housing to fall, because otherwise its banking system will implode under all the mortgage debt. In turn, this implosion in Canadian housing and banking will likely cause debt defaults in the US, given how interconnected they are, and the US is connected to, well, everyone else. And so, Canada must continue to print obscene amounts of money, and it must continue to allow practically limitless immigration, because otherwise it could actually cause the whole global financial system to collapse. The same is true across most of the Western world, particularly Europe, the UK, and the US. The thing is that the average person probably isn't going to put up with this. As we predicted in our video about the upcoming housing market crash in August of 2022, the rise in the cost of assets and goods and services will eventually cause the public to blame the rich and immigrants for their current conditions. But again, this is not the fault of the rich or the immigrants per se, but rather the result of decades of short-term decisions being made by politicians, business people, and even the average person. These decisions were skewed towards borrowing today at the expense of tomorrow. And well, tomorrow has come. Now, in theory, this can be solved through inflation, through devaluing money until the debts are worth little to nothing. In practice, though, it's hard to see how this is possible given the staggering debts that have been accumulated. In truth, the only solution is to allow the collapse to happen and rebuild from the rubble. If history is any indication, then there's probably not much we can do to stop the trend that's been set in motion. That's because it's just part of the cycle created by human nature, a cycle that often takes generations to play out. Unfortunately, it seems we're just in time to experience the worst part of it. Fortunately, though, there are ways that we can lessen the impact it will have on our daily lives. That means not only minimizing the rising costs of assets, goods, and services, but also minimizing our exposure to the politics of wealth and immigration, which could get polarized to the point of civil or even cross-border war. This brings me to the big question, and that's what you can do to keep up with the cost of living. The answer involves addressing the three elements we've discussed: the supply side, aka energy costs, and both elements of the demand side, the assets and the goods and services. The easiest way to address these factors is to move to a country that is abundant in energy, doesn't print too much money, and doesn't have relentless immigration. This is easier said than done because many of the countries that meet these criteria aren't necessarily places that you would want to live. Seeing as debt is the core driver behind the rising cost of living, it's safe to assume that the least indebted countries are the ones you'd want to consider. These include Brunei, Kuwait and the Cayman Islands, and also Burundi, Russia, and apparently also Palestine. Note that this is for government debt. For household debt, the list includes Mexico, Latvia and Hungary, and also Ukraine, Pakistan and Sierra Leone. There are pros and cons to each of these countries, which is putting it rather mildly in some cases. Now, for those of you who are unable to move, your best bet is to consider relocating within your country to a place that is less likely to be affected by the factors causing prices to rise. This could be a region with cheaper energy, less asset price inflation, or less immigration. Some people call it the countryside. In all seriousness, if you are unable to relocate within your own country, then you need to try and be as close to the money printer as you possibly can be. This means working in industries that are being heavily funded by government spending, or in adjacent industries that benefit from their money printing. Similarly, you could invest in the companies that are the most likely to receive government contracts or subsidies. You may disagree with what these companies do, but ask yourself the most important question in investing. Do you want to be right, or do you want to make money? Or, in this case, do you want to keep up? Alternatively, if you believe that you have the power to make a change in your country, then try to petition your government to invest in reliable and constant energy sources. That's because the more energy you have, the cheaper things get. Remember that energy is required for everything. Now, this doesn't mean lobbying for oil and gas companies. In many countries, oil and gas is even less viable than wind and solar. In such countries, nuclear is the best option, and the only reason reactors aren't being made is because of regulations that were put in place by the oil and gas industry, among others. Seriously, look it up. Anyways, increasing energy would not only bring down costs, but it would also boost economic growth, that is, increase the overall wealth of everyone in the country. With enough productivity, it's possible to grow out of all the debt that's been accumulated, reducing inequality and stabilizing migration. For what it's worth, it looks like some countries are starting to appreciate the reality of the situation. The first ones that address it will profit the most. So, be sure to keep your eye out for these developments, even if you're not into politics. It's going to be an interesting world when this part of the cycle is over. And if you play your cards right, you may just end up on top when the dust finally settles. And that is all for today's video, folks. So if you found it informative, let us know by smashing that like button. If you want to stay informed, be sure to subscribe to the channel and ping that notification bell. And if you want to help inform others about why everything is so damn expensive, take a second to share this video with them. With all that said, thank you all so much for watching, and I will see you in the next one. This is Guy, signing off.